Well, nice to be here. Thank you for the time. I love speaking with groups of engaged and interested investors on this topic. What we're going to talk about today is sure the longevity pension fund, but I want to actually extract it a little bit higher than that for most of our conversation. Love to hear your questions, your thoughts, your probe me on things, whether conceptual or specific to our fund. But the topic here is, how do you turn your retirement savings? So many of you acknowledge you have a workplace sponsored pension. I presume a lot of those are DC pensions. I'll share some stats on that later. But how do you turn that, whether it's through your employer or through your personal savings, registered or otherwise, into lasting income? That's something I am obsessive over, that fundamental problem. And it's something that our longevity pension fund is designed to solve. I need to put these up. I will be talking about a fund, so our legal team notes that I must show this. If anyone would like this text, I can send it to you through Dale or Brent. This is the disclaimers. There are a number of risks outlined in the prospectus of every mutual fund, including longevity pension fund, which is the one I will be touching on today. But with that out of the way, quickly, an introduction to purpose. I won't spend too much time. Some of you may know us from our incessant advertising on Air Canada. We for those of you that are Air Canada flyers, we've been advertising before you get to watch your chosen movie or TV show in the back of the seat in front of you. We've been there for 12 years or 13 years since our founding. We were founded by Som Safe, a fairly prominent Canadian financial entrepreneur. Today, we manage about $27 billion in funds. We have, I forget the exact number, 8 or 9 billion on our wealth platform. So we're building a robust wealth channel that is both as an asset manager and as a wealth platform with working with advisors. We run all sorts of strategies. We are backed by, employees own a good portion of the company. I think it should say partial. I don't think it's 50% or more. But we're also backed by Omer's pension plan and the European insurance giant Allianz. So that's a little bit about purpose. I'm going to structure the talk today in 3 parts. First, we'll talk about the retirement income challenge generally, why it's hard, different ways of solving it. I'll then pivot into the longevity pension fund, how it works. I'm sure there's lots of questions there. And then I'll close with an example of it in action, kind of what it can look like in a portfolio. So decumulation, this concept of how do we take the assets we've accumulated in our working years, when hopefully for most of us, we were able to spend a little bit less than our total take was, such that our net worth is growing over time. This is famously called the nastiest and hardest problem in finance, and not by a dummy, by William Sharpe, a Stanford professor and Nobel laureate in economics. So it's acknowledged that there's aspects of decumulation and retirement that I'll touch on today that actually make this a very difficult thing to solve mathematically or in practice. We like to think about, not to distill a human life down onto a single page, but if you did, our journey being born at the left side of this page, through a full human life at the right side, is a series of important stages. And you can see we've divided it into several. Financially, we're not really much until we're about 18. Until you have some income, you're kind of just a cost item for your parents. I have a young child at home, so I know that well. Once you start working or kind of out of school, you have some income, your financial needs get a lot more complicated. You're probably not saving yet, but you're now at least an independent financial person. But broadly speaking, we think about the accumulation phase as everything from, call it 18 to 65, those years when we might have an income of some kind, we're saving away, and as the blue triangle represents, hopefully our net worth is rising over that time, such that then, when our human capital is depleted, our ability to convert our time and effort into resources is depleted, and oversimplification here, but then decumulation kicks in some form. And in this graphic, it's a very simple straight line down from age 65 to 100. But I think if there's a premise I I hope I land with you today, it's that is a gross oversimplification. It's actually very complicated, most obviously because 100 is not the end point for almost anyone. It's earlier or later for almost everyone. So this is how we think about it. We really like taking a life cycle journey approach to thinking about financial decisions and planning. And it was this that helped us frame why we created the Longevity Pension Fund. So first poll question. I'm glad to see everyone put hi in the chat and that you have or don't have a pension. But I want to start with a simple one, which is if you take a 65-year-old Canadian woman, what is the average age she can expect to live to? Just type in your guess. I'm going to pull up the chat so I can see these answers coming in real time. There's no judgment here. It's just to understand where people are at.
Yeah.
Okay, so I'm seeing lots of numbers. Actually, as a group, you are almost spot on, and a number of you might be actuaries. Because as I understand it, well, Dale nailed it there. I mean, the number I have, and I don't want to split hairs about exact numbers. The number I have from the Canadian mortality data is that a 65-year-old woman will live to be about 87. And so, Dale, I think you got it spot on. We have estimates as high as 95. We have estimates as low as 82, I think. So those are the bookends. I mean, I ask this at conferences with people who work in pensions, and sometimes you actually get worse answers than this, even from that group, who I think, we would hope are highly educated on the subject. But that is the average, and I think by and large you understood that. But I'm going to ask a second question, phrased differently. So that same woman, if she wanted to be 90% confident that she won't run out of money, what age would she have to plan to make her funds last to? So phrased as an actuarial question, what is the 10th percentile age that a 65-year-old Canadian woman will pass away at? So what time is it? It's 12:14. Okay, so the answers shift here. I get 195. So everyone's in the 90s. Some in the 80s, but most of you were in the 90s. And so this is where I think it's actually quite shocking. The answer here is it's actually a little bit over 100. I think it rounds to the 100th year. I don't think it's quite 101. But a 65-year-old Canadian woman has an 11% chance of living to 100. So let's call it 100.5. Very few people get that right. In fact, I will admit the first time I heard it from members of my team, I thought they were mistaken on the math. I thought they'd done the math wrong.
It's shocking. That's a shocking number.
It is really shocking. And I think one of the reasons it's shocking is because most of us can't relate to that. I've had no relatives live to 100, not ones I can remember or even family lore. I don't know any people over 100 today. And so it really doesn't match our kind of lived experience. But I think it is what the actuaries tell us. It's also what FP Canada, the financial planning organization that guides financial planners in Canada, it's what it tells them. So there are many reasons to believe that you have a 1 in 10 chance of living to 100. Not many people make it to 105, so mortality is very high at that point. But there are assertions now that the first person to live to 150 is probably walking around on Earth today. That's now we're talking more about extreme tail situations. The oldest Canadian ever was a woman in Quebec who lived to be 116 and a half, documented. So my point is, the average 65-year-old has about 22 years of life expectancy left, but that same 65-year-old actually has a 10% chance of living at least 35 more years, right? And so, when we think about planning, this is really the crux of why retirement is so challenging. So this is a graph. I love this. Anyone familiar with log normal distribution or Gaussian distribution will recognize this classic bell-shaped curve. Standing at the left side of this chart as a 65-year-old, for some reason I've switched to males, but the data is not that different. You can see that male expectancy is to about 86. Women are a little bit longer. But you can see here, there is that natural bell shape. The most likely age that a 65-year-old will pass away at is about 88 or 89. It looks around the same in both of those years. But I divided into 4 quadrants. So a 25% chance that 65-year-old dies within the next 15 or 16 years by age 80.5. 25% in the next 6.5 years by age 87. 25%, 87 to 92. And then this very long tail of 25% between 92 and call it 115. So this is the challenge, is that none of us really know. We may have indicators, we may be healthy or unhealthy. We may have genetic reasons to believe we'll live a long time. We may have immediate knowledge that either we're very healthy for our age or we have a terminal condition. We have different information, but for most people going into or in retirement, there's absolutely a degree of uncertainty about what this looks like. If we knew the year we would pass away, retirement would be an entirely different thing to fund, entirely different. But we don't. There's a great deal of uncertainty. Layering onto this, it's not in my slide, but I'll just build on it, is the idea that it's one of many uncertainties. We don't know what the stock market is going to do or what our portfolio is going to do. We don't know what prices are going to do. Even if we knew what prices are going to do, that on average, the basket of Canadian goods would rise 2% a year, 3% a year in line with inflation targets, who knows what basket we need? I don't know when I'm 90, will I be buying golf balls and golf club memberships and airplane tickets to travel? Or will I need medical devices and nursing care and advanced life support systems? I don't know. Both of those are possibilities. And so the basket of goods we need is also uncertain. So headline inflation numbers are only part of the picture because inflation is an average of what's happening to costs across all the baskets of things we need. My point is, lifespan uncertainty adds to a series of other uncertainties that make this really challenging to plan for. Doesn't mean there's not ways to do it, but it just means it's challenging. So the question that we often hear, actually, let me pause there for a second. Any questions on that, on the mortality data or how to think about it?
Yeah, if you have a question, please use the react button at the bottom, raise your hand. Or if you don't know how to do that, you can just physically raise your hand if you're on the screen. Not everyone's on the screen right now, but I can call you. Anyone have any questions or comments? Or
I would just add, we had to tour a lot of old age homes for my mom. We went into one and we were told that something like there were like in that home there were like 24% of the people in there were over 95. It was just outrageous. It's like my mom's an old age home. We had to visit a lot of tours, but it is when you get into that segment and that sort of world, if you will, you do see the striking and kind of shocking longevity for a sizable component.
Yeah. Well, Dale, I think it's coincidental more than foundational, but it happens to line up to that right quadrant, 25% chance of living to something 92 or older. So I don't want to say those line up by definition, but I think coincidentally they do.
Yeah,
like
Peter has his hand raised.
Yeah.
Mm-hmm.
Yeah, Fraser, I just wonder if you have any view of how that Gaussian curve might be skewing to the right over time or left. Are people living longer?
They are. It's a great question, Peter, and I think I've taken out the slide I have on it. People are living longer. The reason I've taken the slide out is I think even though it's happening, it actually is everything I've told you so far. Every statement I've made is true whether people are living longer or not. I think framing it around the fact that we're living longer is interesting, and it's an exacerbating factor, but it can be distracting to the fact that even if it's not, and what's happening, by the way, is it's stretching out, it's not shifting out. So when you think about what this graph would look like if we wanted to adapt it, or if I was redoing this 20 years in the future or 20 years in the past, 20 years in the future, we would stretch the picture to the right. It's not like everyone is living longer, And I'm not an actuary, but actuaries do, they're very, very nuanced work as to what subpopulations are growing and what's happening. But by and large, it is stretching. It makes it challenging for retirement because it's a longer period of time. As I understand it, in the 1970s, when DC pensions hit their peak prevalence, so in the mid to late 70s, I think it was 77, approximately half of all workers in Canada had a defined benefit plan. And at the time, life expectancy was, for a 65-year-old, was to like 73 or 74 or something like that. As I understand it, it was sub a decade. And so very different period. If you retired with, call it 5 years savings, 5 years of your salary saved up. So if you make $100,000, you had $500,000 in the bank. You can kind of make that last for like, 6 or 7 years with some interest on it and so forth. But the idea that now we still sort of retire around 65 in many cases, though retirement itself is a complex thing. It's not a straight line like our blue triangle showed on that earlier slide. It's far more complicated. A lot of people slow down their income. They take on volunteering. They do part-time. But the point is, because of that extension of life expectancy, retirement can, even on average, be a 22-year thing. Call it, 2.5 to 3 times what it was 50 years ago. And in the extreme cases, it can go 35 or even 4 years. So when we do our modeling for the Longevity Pension Fund, we do all our modeling through an age of 110. Because there's if you start with a large number of people, there's a very, very small number of them. It's not big, but still, alive and living in a retirement community somewhere that far down the road when you model it out. So it's a good question, but I think it's not the primary. It's not required for all of this to be true.
Just
I was just trying to be optimistic.
You have good reason to be optimistic.
Just a question there, comment there from Jim. Oh, just come back to your graph there.
Yeah,
I think
sorry.
Jim's pointing out something. I think he's right. Your numbers it should probably say 75% chance of living to 80, not 25% chance of living to 80.
Yeah, well, I see where he's going with that. What I mean is, like, there's a 25% chance of the blue bars represent 25%. I mean, technically you're right. 75% of people will still be left at age 80.5 is a different way of phrasing it. I just mean
different way of phrasing it,
a quarter of people will die, to put it bluntly, by 80.5. 25% will die in that 6-year band. 25% will die in the yellow band, and 25% will die. But yeah, 75% of people are still alive at age 80.5. It is that's a true way of reading it. Okay, so let me shift then. The question for us as investors that it raises, and as citizens who've worked and saved, some as much as they wanted, some not as much as they wanted, but no matter how much you have, whether it's $100,000, $1 million, $10 million, there is a question that that people raise, which is, will my money last? Will I run out? The idea of running out of money, the idea that I will live to be 97 physically. Like that's the year I will pass away, but I sort of run out of money at 92. That's just not an option. Like it doesn't work for obvious reasons. It either means I'm likely uncomfortable, or my children are burdened, or it's not a good outcome. There's another way of phrasing this. I actually think the better question that people have, or the more nuanced version, is how much can I spend each year? It's not will I run out? Will I go to a bank machine and it rejects my card because I got nothing left? It's how much can I responsibly spend? How much should I spend? What's a reasonable amount? There's an idea that people have what's your income need in retirement? And I challenge it a bit because, I could make do with a little less. I could do a bit more with a bit more. I think a lot of us have some flexibility. I describe it as, I can shift to off-brand peanut butter, or I can take an extra vacation every year. Like, there are ways that we can flex. And so there are income needs, but there are also wants. And so I think a good way of phrasing the question is, what is a responsible spending amount each year? So an investor making that decision using a traditional portfolio. When I use the term traditional portfolio, what I just mean is a thoughtfully constructed, balanced portfolio of stocks and bonds. It's what most of us have. It's what I have. And if you are drawing from that, you have some choices in the face of that lifespan uncertainty. The first is you can spend conservatively, right? We'll get into what that number is in a minute. But if I've got $1 million saved and I retired this year, I can spend at a very low rate and sort of do the thrifty thing. And what will happen is I will likely pass away with most of my assets unspent. You recall that in 75% of cases I'm dead by 92, because there was the 25% where you live past 92. And so if I spend conservatively, I will likely pass away with most of it unspent. The other extreme, you can see where I'm going with this, is I can spend aggressively. This is the sort of hope as a strategy, and say, I'm just going to spend, throw caution to the wind. Let's see how it goes. And there is a pretty good chance that I will run out. I'm playing with fire there, a bit of Russian roulette. And it's not actually running out. What it is it's cutting back dramatically. It's realizing that I'm at age 90, I'm still healthy, and at my current spending rate, I only have 2 years of spending left, and so making dramatic changes. Right? It's not the 4-star long-term care or retirement facility. It's the 1-star. Right? It's real dramatic changes to spending. Now, you may be pointing out, you saw I left a gap there for a middle option. There is a middle option to neither spend conservatively nor aggressively. But it's not like the warm porridge in Goldilocks where the middle one is perfect. What it actually leaves you with is a bit of both risks. Right? If I spend somewhere between conservative and aggressive, I don't wipe away those two risks. I actually just have some of each. And so it can work. It's what most of us do, and it's actually the smartest approach. Somewhere between kind of conservative and in the middle is the smart approach. But just be clear, the risks don't cancel, and you're not eliminating them. You just have a sort of moderate of each rather than high of one and low of the other, or low of one and high of the other. So these are the choices we kind of face, and this is what inspired us to try to tackle this. So let me back up and just make sure we're all on the same page about how the Canadian retirement income system works. Really, there's 3 pillars, and I think we're intuitively familiar with these, though many of us may not have spelled it out. Pillar 1 is government programs, so CPP, old age security, GIS for those who qualify. We're lucky to live in a country that tries to take steps to make sure that even the less fortunate are comfortable in retirement, and that this is not a time of poverty. So government programs are, pillar 1 for a reason. They're kind of the bedrock. Pillar 2 is workplace programs. Not everyone has access to these, but for a decent portion of the population, whether it's a defined benefit pension or a defined contribution account, DCPP, or a group RSP, many people save through their employer, often in ways that are not mandated, but that are facilitated. The third pillar is personal retirement savings. So it's everything we do outside of 1 and 2. So those are the 3 pillars. I think, they're all important. Anything I talk about today is not to replace one pillar with the other. It's about how can we do the most with each of these pillars in order to have the best retirement possible. For almost every investor, who has both workplace programs and some retirement savings, a mix of these 3. It's often called a 3-legged stool to give that sense of stability from 3 legs. But this is what sort of how the system works at a very high level. Now, I just wanted to touch on quickly defined benefit pension plans. What we're looking at here, it only goes back to 1999. So I talked about in the mid-70s, it was around 50%. But the private sector workers who have a defined benefit pension plan at 25 years ago was about 1 in 5. By 5 or 6 years ago, it was less than 1 in 10. And you can see that trend line, it continues to fall. So defined benefit pensions, that idea of an income for the rest of our lives, it provides a degree of security in the small chance that I live to be 104. I know that I will have that income coming in. That was covered by DB pensions. That is a reality for a much smaller portion of the Canadian population than it used to be. And that's important context for this. Okay, so what does someone do who's no longer working is looking at a balance in their account, and they're trying to figure out how much income they can draw. Answer that question I showed that woman contemplating. How much can I safely spend so that my money doesn't run out? 4 approaches here, each representing sort of a different fundamental way of framing it. Blue, many people simply spend what the CRA forces them to take out of their RIF, right? So starting at age 70, you're forced to withdraw from your RIF. It starts just over 5%. It goes up very high by the time you're in your mid-90s and thereafter. But many people use either what the government forces them to take out of their RIF or the income that's generated by their account. They're using external cues to determine how much is safe to spend. There is some logic there. Many people follow a version of the 4% rule. It's not 4% for everyone. Some people think the number should be higher. Many think the number should be lower. It's called the 4% rule because it was proven in the United States in the 1990s that over any 30-year period, going back, I think, to the 1930s through the 90s, so a whole set of, 1930 to 1959, 1931 to 1960, etc. You would never run out of money if you were invested in a balanced portfolio and you started withdrawing 4% of your money and raised that with inflation. So if you've got $1 million to start, you draw $40,000 in the first year, $40,600 or whatever it is raised for inflation in the second year, and so on. You would never run out of money over 30 years. What you're really doing with that approach, the reason it's 4%, well, let me ask that to the group. Does anyone know why 4% might be the number? What does that represent? Is there a mathematical or conceptual way of getting to 4%?
Anyone want to put their hand up? Inflation, someone says.
Yeah, so inflation's close. Inflation's kind of directionally right.
So we have average ROI, age expectancy of 100.
It actually has nothing to do with age expectancy, though it relates to it. 30 years is a long enough period that you can't be depleting your assets. If you're raising your withdrawals annually with inflation, if you were depleting your assets, the sort of downward snowball effect will kick in pretty quickly. So 4%, the simplest way to derive it is think of a portfolio doing about 6.5% a year in nominal returns, right? Our portfolios grow nominally in dollars. Subtracting 2.5% for inflation gets you to about 4%. The best way to think of the 4% rule is you are withdrawing your real market gains on average. So over some years it's going to go up more, some years it's going to go less, but over time, most balanced portfolios will do about 6.5%, call it 6 to 7. And so subtract inflation. What that means, the implication of that is that you retire with $1 million at age 65, 30 years later, if you're still alive at 95, your bank account is going to read much higher than that. You're going to have approximately $1 million in, if that was today, in 2055 dollars. You'll have about $1 million. So your bank account might read $2.7 million. You are living off the real gains. You are maintaining your balance. Okay, moving to the orange box. 75%. Many people define retirement income needs as related to your pre-retirement income because you no longer have a spending burden, and for many people, your spend goes down for a variety of reasons. The challenge there is that notice that it has nothing to do with how much money you have saved. If I make $100,000 a year and have only saved $200,000, the orange rule would say I can spend $75,000 a year. I will blow through my $200,000 in 2 or 3 years. That is, it's not a supply-driven approach. It's a demand-driven. I have the need or the demand for 3/4 of my prior income. I may or may not have the ability to supply that sustainably. And finally, the red box, make it last to some age. This is, a reasonable approach if that age is 100 rather than 87. If you think about an age that you are unlikely to hit or surpass and make sure that your money can last to that, that is a pretty sensible approach. anyone who looks at their life expectancy and says, let me make this last until my average age, it also happens to be the median, meaning half of people live past it, means you have a 50% chance of literally running out of money. And what's even more noteworthy is that most people will live to be close enough to that age. Call it 80% of people will get close enough to that age that they dramatically cut back because it is a cliff staring them in the face. So these are some rules of thumb for how people can think about drawing income. For some fortunate people, they don't need to have these conversations. They have $10 million in the bank and they only need to spend $200,000 a year. So forget the math, forget the calculations. It's easy. Their balance is going to grow. That's not most Canadians. That's a very rare and rarefied set. For some people on the other end of the spectrum, they laugh at something like this. They only have $50,000 going into retirement. That's a real challenge. They will be dependent on government programs and perhaps support and generosity of others. But for a lot of middle-class Canadians, you've got to figure out how to do the most with it. The way I describe this is for many people, they've saved enough money that the cards they've got in their hand, so to speak, I'm using a poker analogy, can actually make for a wonderful retirement if it's played right, but that's not a guarantee, right? There's careful decisions need to be made. Okay, let me pause there again. Any questions on these strategies? Any comments or questions?
Feel free to again raise your hand, or
we can debate whether 4% is
you-
the right number. If anyone has comments on what the 4% number should be, that's a whole other presentation.
I think you're good. How are you tracking? You got about 20 minutes left. Does that work?
Yeah, I'll keep talking fast.
Okay.
Okay, so the one question is how much to draw. If I'm retiring at 65 with $1 million, how much can I draw each year just to supplement what I'm getting from government programs and any other sources? The second question is, what do I do with that money, right? Most of us who have saved for retirement have done so with a balanced portfolio of traditional investments, that upper left box. That is kind of the setup for accumulating for most of us, and so it's what we go into decumulation with. But I have several options, right? I always have the option of de-risking my portfolio by shifting to the right and taking interest-bearing accounts, GICs, money market funds, things that pay some level of return. It's typically modest because I'm not being rewarded for taking on risk, right? By eliminating that variability in my year-to-year return, that's a good thing, I'm forced to therefore accept less on average. If I shift that whole $1 million into a GIC, what will I get now? About 2.5%, maybe 3%, like something in that range. Far less than the expected return on a balanced portfolio of global stocks. And yet, which one of those two is it has the possibility that it will be negative next year? The global portfolio of stocks, right? So I can do that. We have the ability to buy annuities from insurance companies that some people take happily because they are guaranteed a paycheck for the rest of their life. If I live to 106, I am laughing all the way. If I live to 97, I am laughing all the way. If I get hit by a bus at 68, well, that's too bad. That investment didn't work out as well as I'd hoped. But that guarantee of income where I don't have to worry about what the global economy is doing, as long as the insurance company stays solvent, which is quite likely. I don't have to worry how long I live. What we're adding here with our longevity pension fund is the idea of income funds that add longevity risk pooling. The best way to think of it, it is like that traditional portfolio in the top left box, but with the risk pooling concept built in, meaning I'm protected against the chance that I live substantially longer than the average. Okay, I want to talk about longevity risk, and so I think we're going to shift to visual pools. I'm going to stop sharing my slides for a second. But there's two questions here. What is longevity risk? And then the next one is what is longevity risk pooling? So I think Brent is going to share that in the chat. Is that right?
Yeah, so I've put the link in the chat. I don't know Pat, if you can do that while you're biking. Yeah. So that should take you, and I'm going to share my screen. And that should take you to the Mighty Networks page. And so if you take the link there, there's 4 options. You should be able to click on the poll. So we'll just take a minute to do that. Give everyone a chance to jump out of their Zoom video for a minute. Everyone, I heard a ding. People are voting. I see the Dale and Michael. Very good. Worst case scenario, if you can't figure this out, just use the chat and put the letter.
Right.
That's our our plan B. Okay, we'll just wait till everyone's they're voting here, and then let's see here. I'll just refresh my screen. Just give me a second.
Let's get up to 6 or 7 votes, and then we'll.
Yeah.
So while that's coming back, I'm curious to see what the graph or the results chart looks like. But what I'll say is, I see B in the
I have to vote myself here. What's longevity?
So on the what longevity risk is, B is a common answer.
100%.
On now we're on longevity risk. Longevity risk. Can we go back to the first one on longevity risk?
Oh, I'm sorry. Did I do the wrong one?
There's 2. I think you had the first one.
Sorry. Yep.
Yeah. The question on.
Let me just zoom in again. Sorry.
Okay, so we do. Let me jump to kind of as anyone's putting in. I mean, I think I've made the point with the poll here, but I think a lot of people would frame longevity risk as B. The idea that there's some chance I live well beyond the average, that sort of risk of implosion of my plan. But I think the much more helpful framing of longevity risk in your mind is D, which is it's actually the idea that there are financial planning challenges that come because there's uncertainty. The same way risk in financial markets isn't just sort of the chance at any moment that there could be like a market meltdown. Risk is actually the volatility or the uncertainty about what a portfolio is going to do. So risk is present even when things are rising. It's just the idea that even in fact when there's good years, it's better to think of risk as that variability than sort of the small possibility of a really bad outcome. So that's the first part and the point I wanted to make. If we go to longevity risk pooling, I think it's actually simpler. Can I see the answers to that?
Yeah. So I've got the link again in the.
And I think some people had already voted on that one, but
it was a couple people, yeah. But I put the link in the chat again. So if you want to.
So okay. So looking here.
Just give them a minute to vote. There's only a couple. Yeah, just give them a second to.
Okay, sounds good.
Weigh in there.
Yeah, and so okay, so yeah, I'll hold off on that. But I see that actually, if I think back to the first question, it looked like B was the more popular answer because that is often how we think about risk, is we think about it as a chance of something really bad happening. Frame it in your mind in this case as just how hard it is to make an effective decision about what to spend in the face of all those uncertainties I described, including uncertainty about whether you've got 2 or 42 years left on Earth. That's the challenge. Okay, now if I we're going to refresh on longevity risk pooling,
there you go.
And I think that's right. Okay, so B had been the first answer and looked like 100%, but it is in fact C. It's this idea of sharing of our uncertainty about individual lifespan with other people, so that everyone can have a good financial outcome. Risk pooling is what we do in different insurance products. I pool my car accident risk, which is to say the uncertainty about what my annual car accident cost will be. Most years it will be 0, but some years it could be very high. I pool that with other drivers by buying an insurance policy that costs me about $2,000 a year. I think in Canada we all have to do that by government mandate. But nonetheless, that's what we're effectively doing. We're simply saying, rather than have some small fraction of us owe, tens or hundreds of thousands of dollars in car accident consequences. Let's pool that risk and have everyone incur a $2,000 or thereabouts cost, and that is car accident risk pooling. Longevity risk pooling is replace the car accident with lifespan uncertainty, and that's the similar analogy. So I will resume sharing here and keep pushing through my.
Thanks for everyone participating there. Yeah.
Yeah, thanks. Appreciate it. Hope it keeps you engaged. Okay, let's talk about the longevity pension fund. So I sort of alluded to this, but our answer to this challenge has been to launch the first ever mutual fund that's offering income for life. It's actually the first in the world. And what it gives investors is a balanced portfolio of stocks and bonds, so a similar conservative portfolio to what they likely hold in their retirement accounts today, but with the benefit of longevity risk pooling that creates a lifetime income fund. It gives investors the ability to access unpaid capital at any time before or upon their death, or NAV in rare cases when it's lower, but generally it's the unpaid capital. And what that means is, just to be really specific, an investor who puts in $100,000 into this fund receives, let's say, $20,000 in distributions over the course of 3 years. That's about what it would be. Would receive back $80,000 when they pass away, or if they chose to redeem. Now, the fund might have a NAV, a value of $98,000 or something. They are receiving less, and that's how we generate the longevity risk pooling, is because when investors leave this fund, generally because they passed away, they're leaving some of their assets for the remaining investors. It allows us to pool their risk, pay income for life to everyone, and give that confidence of income for life. What it allows for is positive, attractive starting income payments, much higher generally than annuities, and designed, or a little bit higher than annuities, but designed to increase the payment levels over time. That's how the fund works. The fund pools risk in cohorts. So we currently have 6 cohorts running from birth years 1945 to 1962. So each cohort is 3 birth years. You can see them there. We've included the age turning in 2025 just as a reference point, but really it's the birth year that defines it. And you can see what the yield is. So based on Friday's closing prices for these fund units and the annual distribution that's paid, you can see what the yield is that you would be receiving on each of those units. So as you can see, for the people that are in their late 70s now, it's almost 9%. For people that are just turning 65, and you can only buy this fund once you've turned 65, so I suppose that means they were born in 1960 before September 23rd, the yield is just shy of 6%. So the yield is designed to rise over time for each of these cohorts, but as you can see, it already is skewing higher the older someone is. And why is that? It's because as a group, that older cohort has less future life expectancy remaining. We don't know what any one person is going to do. We've got a pretty good idea what a group of people born in the mid-1940s is going to do. So a couple of key points on it. Distribution levels are adjusted up or down each year with what happens in markets and what's happened with the experienced mortality. It is not guaranteed or fixed. If you're looking for a guaranteed or fixed lifetime income solution, an annuity is absolutely the product for you. There's pros and cons to each. Lots of our investors also hold annuities, and some people look at our fund and buy annuities, and some people look at annuities and buy our fund. As I said, investors are leaving some or all of their assets in the fund when they leave. They're leaving it in for the surviving investors, and it's not transferable to a spouse or a child or anyone else for what I think are logical reasons. It ties to a person's life. Couples that want to use this are putting some in each person's name. The portion that is in whoever passes away first, those units will redeem, either providing something for the other or not, but it would then leave the other person's assets, units generating income. This is not a brand new concept. They've been doing this in the US under TIA's CREF product since the 1950s. In UBC, I don't know if anyone on the call is out in BC, but they've been running this for almost 60 years. Professor's plan as an option, which many are choosing. Australia's innovated in this because they don't really have a CPP. They've mandated huge amounts of DC plan style savings that they now need to turn into lifetime income. And we launched this in 2021. So we're innovators globally through the mutual fund construct, but we're building on a centuries old idea of what's called a tontine, some of you may have heard of, and we're building on a more recent legacy of decades of work to put this in sort of modern plan structures. Our innovation was to put it in a mutual fund that can be invested in by regular investors. Okay, I want to share, I realize we're running low on time, so I'm going to push through a couple of things quickly. I really love this look at it, which is, you know, as someone ages, invested in this fund, and they could pass away at any time, right? And my bell curve chart showed that, in fact, most people will pass away around the middle of this chart. But for someone who lives, what is the expected return that their assets are generating each year while invested in the fund? And we like to think of the longevity credits as sort of a type of alpha, which is what most investors are seeking. It's the idea of returns that go above and beyond what they're generating from having market beta. And so, you know, in the early years, the return is about that, the expected return is the investment return. It's the green bar. It's about 5.5%, varies from year to year what we expect it would generate. But it's pretty minimal because even as people pass away, they're not leaving a lot behind because they're taking most of their assets with them, and because mortality is low in those early years when people are younger. But what happens is, as the unpaid capital starts to diminish, as people have been in the fund for longer, and as mortality starts to increase as the group ages, the mortality credits, that yellow bar that sits above the green, starts to grow. That means the expected total return on the assets that an 85-year-old has is almost equal between market returns and longevity credits flowing from other members in the cohort passing away. That continues to build, and as the group gets into its 90s and then 100s, the flow of those mortality credits is expected to rise dramatically. I mean, you can see that by age 100, you know, it's almost all like the portfolio return. If you started with $100,000 in NAV when you're 100, you'd expect about 5,000 on average of market gains. And what is that, about 48,000 dollars worth of mortality gains. Now, this isn't free in that sense, right? The cost that you pay for that portfolio alpha is that you receive it while you're living and you give it back into the fund when you exit, you know, typically by passing away. So that's the trade-off that is embedded into the fund structure and makes it enables income for life. So, you know, here's
a question on that.
Yeah.
Fraser, sorry to interrupt. The amounts that come from the mortality credit, if you will, are they invested in any special way, or are they just going to the general pool of the?
They go back in. They go back into the general pool. It's they're accretive. It's the best way to think of it is there's sort of the same dollars left in the fund and now fewer units claiming them. So if you've got 20 units of the fund, they now have claim to more of the assets because there's fewer people. So yeah, the portfolio is always managed in a very balanced portfolio. It's available on our website, retirewithlongevity.com. It's a blend of Canadian, U.S. equities, fixed income, very high quality fixed income, of course. There's some alternative assets in there, some energy, some commodities, some precious metals. There's a cash sleeve earning, 2.5–3%. It's a very balanced portfolio, but it's the same whether it's coming from longevity credits or is sort of the base portfolio.
I'll just step in quick.
Looks like the rate of return at the end would get quite outrageous. Is that right, or is there some smoothing, or is it as sort of good as it looks?
Well, there's smoothing in the form of. Let me actually jump ahead here. What I want to show is okay. So this chart is now showing year zero. Think of as age 65. It's the year someone invests in the fund. The way that the fund determines its the appropriate level of income to be paying is designed to rise over time. So as that, what's happening is as that flow of mortality credits is increasing, we can actually be paying more income to each investor in the fund, even with less assets to their name, because the anticipated mortality of every member is so much higher than it used to be. And so we work with partners at TELUS Health. It was called LifeWorks, and before that, Morneau Chappelle. So Canada's preeminent actuarial pension consultancy. Every year we publish an annual report for the fund where we are transparent about how the fund is making decisions. And this is, I realize it's a little bit of a complicated chart, but the average expected increase in distributions over time is this line with the red dots. And that rise is approximately 2% a year. So this fund is designed on average, even though it's not guaranteed, to increase its distributions in line with expected inflation, keeping investors roughly on track with a constant real income out of their units in the fund. So that's how that increasing mortality and mortality credits or longevity credits, flows back to investors. This fund is not designed to pay a jackpot to some 111-year-old. That's not at all what we want to do. We always want to be paying as much to each investor in the fund as we can do with confidence, not total confidence that it'll never go down, but with a high degree of confidence that that level is sustainable.
Right. Mortality credits are shared, if you will, might be a good way to sort of frame that.
That's exactly right. That's structured in. Let me show you the history of the fund. We launched this in June of 2021. You'll recall 2022 was a really tough year in markets. This fund, on its year, September 30th to September 30th, for the year ending September 2022, the fund was down about 7%, while a balanced portfolio was down, 14, 15%. The fund deliberately has buffer built into it. So there's a number of structures designed to prevent the likelihood and severity of decreases. So we were able to hold these distributions constant through the first 3 years of the fund. Last year, so the year ended almost a year ago, the fund had a 16.2% return on the portfolio. So it passed through, as you can see there, it passed through an increase across the existing cohorts. Cohort 6 was launched in January, so it didn't exist. It shows as flat, but all the existing cohorts raised their distributions. This year, the fund, as you can see on our website, has done a little over 9% return on a target of between 5 and 6. And so, while I can't officially comment on what it's likely to do, 9 is above the target of 5 or 6, and so it's reasonable to assume there could be another increase. So that's the fund passing through good years as raises. The fund will someday cut distributions. That's not failure. That's the fund responding to variability. We try to manage the portfolio so that that's less common, but we're not trying to provide guarantees. This is for people who want the benefits of a balanced portfolio as investors, but want to layer longevity risk protection on top of that and are comfortable with a little bit of variability from year to year. So it's 1 o'clock. Why don't I pause there?
A few questions.
I got through most of my slides. I'm sure there's some questions. I'm happy to take them for the next few minutes.
Yeah, again, top of the hour, so if you need to leave, feel free to do that, but we'll stay on here in our overtime. So I'm just seeing Teresa had a question here. What's the average age a person starts an annuity cash flow plan?
So annuities are by definition an insurance product put out by an insurance company.
Right.
I'm not sure of the average age people start. Generally, and annuities is a broad bucket of insurance products, but I think when I talk about an annuity, what I mean is a lifetime annuity that pays. They go by different terms, but they're kind of single payment lifetime annuities. This idea of you hand over a lump sum of cash to an insurance company, and typically for a 65-year-old male, I think the number's about 6% return they'll pay you on a flat basis. those people are likely to start those kind of as they go into retirement. So sometime between, call it in their 60s or 70s, but I don't know the average age that people start them. They're great products.
When I hear from financial planners and just what they put out there, and even as ideas, that they're better a little, don't call it later in life, but when, like at 65 and 66, 7, that's when they get more generous. They might not make a lot of sense at 60, but they start to recommend them around 65, and then even layer them in over years too. So it's not kind of a one-time purchase, but they like to layer annuities as a strategy.
There's all kinds of strategies, Dale, that people can use around them. I mean, the reason the insurance company's being a little more generous as you get older is they're just doing their spreadsheets on the chance that they have to make each payment, and if they think about it on a discounted cash flow basis, their total payout goes down if you don't start it at 65, you started at 68. They know that you saw my chart with that Gaussian curve or log normal curve of distributions. So, the way I look at it is insurance companies aren't nice or mean with these things. They're just, they're organizations trying to provide a product in a competitive market. But one thing I should point out is there's a push to do advanced life annuities, ALDAs, advanced life deferred annuities, where you buy it today. It starts at, I think, as late as 85. And that can actually be a really neat solution to, okay, so there's some chance I live quite a long time. Is there a way I can allocate money earlier to that sleeve of my portfolio? I've got $1 million. I'm going to put 100,000 into an annuity that'll kick in at 85. And the numbers are quite generous because they get your money, they get your 100,000 today. And let's say they get to invest it over 20 years, they can turn that into more with some reliability. And then, they know that you or the pool doesn't have a ton of life expectancy left post 85, and so they're not going to have to make those payments for 30 years starting at that point. So I think the numbers, I forget the exact numbers, but it's sort of it seems wildly generous what you get per $100,000 invested at 65 in terms of annual income starting at 85 in an ALDA structure.
Yeah, and we talked about this. I would get your questions ready. I don't want to take over this.
Yeah, we got lots of
I would suggest that the purpose longevity fund and annuities are a nice pairing, if you will, because annuities are great in that they're income for life if you choose to purchase that, but the risk is inflation on those, right? You might buy it and it's paying 6% by the end. It might inflation terms only paying 2.5, whereas we have the sort of longevity risk covered by the purpose fund. So I think they're a nice pairing.
Yeah, what I'll build on that, and then maybe someone can screen the questions and group them or throw out a couple to me. But if you look here, this is a version of the slide I'd shown you earlier without the labels. But if you think about the stock and bond portfolio upper left and the interest-bearing account, right? That's not an either-or proposition, right? I hold stocks and bonds. That's the majority of my portfolio, but I also hold some money market funds that bear very little risk. I choose to blend those in a proportion that is suitable for me. Shift from that top row down to the bottom row, the same concept applies. How much do I want to put into a lifetime annuity? How much do I want to put into a variable annuity? I can blend those in whatever proportion to sort of create any shade of gray if you think of those as black and white. And so, to Dale's point, they blend very well, and many of our investors are layering the longevity pension fund on top of annuities. I go back to my comments on our income needs in retirement. I absolutely have income I know I need to have every year in retirement. There's also income I would like to have and I would like to invest to get. Like I will invest towards building it, but it's not required. It's not for my heart medicine. It's for my trips. And so I think it's a great point.
Okay, a few more questions here. I want to make sure we get answered. Diana, do you want to ask the question you posted? Are you available to do that? Okay, I'll just read it out here. She says, are the total portfolio returns shown for each year the annual average return since age 65 or just the return for that year?
I think that was when I had the chart up, the chart showing the alpha. I think that was the chart I was showing returns on.
Okay.
Because I think that was a few minutes.
It was just before 1 o'clock.
Yeah, 9 minutes ago. I think that's what I had up. No, those are annual. Like the fund is expected to do approximately 5.5% annually. Higher some years, lower others, but that's the average expectation. The mortality returns were not cumulative; those were each year. So the point is, if the bar is 40% the year someone's 100, I think it was close to that number. That is to say, actuarially, you expect 40% of the 100-year-olds owning the units of the fund to pass away that year and to put all of their assets back into the fund for the other members. So not cumulative, they are in fact annual.
Okay. And questions, where can it be purchased? BC resident, and can it be purchased and started at 64? And what's the MER?
So MER is 60 basis points, which when you think about everything we're doing in this fund, this is the fund we earn the least money on at Purpose. We're
very reasonable.
Yeah, it's a strategy we believe in. We want to make this as accessible as possible. And so it's a 60 basis point or 0.6% management fee. The MER is capped. Sorry, that was the management fee. The MER is capped at 72 or 73 basis points. So we very little loading of costs into it and capped. So investors are not, facing something that costs could balloon on this. Can it start at 64? So here are the parameters around the fund. I showed you the cohorts. No one born before 1945 can buy this fund, unfortunately. And so anyone who's 81 or older this year, basically, if you're born in 44 or prior, it's not available. Anyone can buy it until you're 60, until the year you're 64, inclusive, but you're buying the accumulation series. It is redeemable at NAV, so it is a very normal fund. It's called our accumulation fund. It's the same portfolio, so you're holding that basket, that pension-style basket of investments. The thing that's unique about that and that makes it special is that the month you turn 65, it rolls over into the decumulation units in the cohort of your choice. So if I'm, let's say I'm 60 today, it will be 5 years before I can roll into my decumulation class. That decumulation cohort does not yet exist. We only create them as they're needed for the birth years. And so because it doesn't exist, I buy into the pool of accumulation units. When I turn 65, I would roll into, I think that's cohort 8, which we will launch in 4 years from now. You cannot buy this fund once you've turned 80. So even if you're born in 1946 or 1952, once you've turned 80, no one can buy this fund. That's because people as they age have increasing visibility into their mortality. And we don't want people being able to say, I'm still healthy at 85, so I'm going to buy this fund.
Okay.
People can buy this based on their health, of course, and their sense. But our actuarial partners said you should cut it off at 80 because you get a sort of a fundamental change in people's visibility into lifespan. And so you can buy this until the day you're 79 and 364 days old.
Okay. Peter had a question. If I invest in the fund...
Go ahead. Sorry, go ahead.
Yeah, no problem. If I invest in the fund with registered funds like RSP, can I split the income with my spouse?
I don't see why not. I think that's a question that's outside the scope of this fund, meaning the fund sits as an asset in your RSP or RIF, and it's designed for those. Also fits in TFSAs, also group plans and DC pensions and so forth. But if it's in a RSP and or a RIF, when the distributions are made, those are going to flow into the account that's holding it. The decision to take money out of that account is yours to make, and that's between you and your dealer. And so I think that decision, when you make it to extract money, is when you would handle things like income splitting. We don't make that decision for you. Income from the longevity pension fund is not in and of itself considered a withdrawal from the RIF. It goes into the RIF account. It's your decision to extract it through your regular withdrawal program or however you're taking money out of that RIF.
Okay.
But there's no obvious issues that you couldn't split this.
Right.
It has more to do with the account, though, than this fund sitting inside that account.
Okay, so Scott's saying here, it's not evident through advertisements or any other means how or where one buys it. So maybe the marketing team needs I don't know if that's purposeful.
Yeah, no, it's not purposeful. I mean, we should, no pun intended on our name. I mean, we're a fund, in this case, we're a fund manufacturer, meaning we're an asset manager who creates the fund. Okay. It is not bought from us directly. It is sold on places where you can buy mutual funds. It's not an ETF structure. The mutual fund structure lets us see who the investor is. That's important for this fund because when someone passes away, we need to know. So not suitable as an ETF, but anywhere you can buy mutual funds. So I'll give you, two examples are some of the big banks. And so National and BMO make it available through their advisors, make it available on their direct platforms. Both BMO and National run direct platforms. Questrade, Qtrade also offer this fund. Companies like Richardson Wealth offer this fund. Odlum Brown, a whole bunch of smaller, independent or non-bank dealers. Some don't. And so, RBC and TD, two of the largest, have not put this fund on their shelf. They have their own solutions to this. We're in sort of ongoing discussions with them. We'd love to see it more broadly accessible. So the short answer is it's the same place you buy any other mutual fund. Some offer it, some don't. Again, our website on this fund is retirewithlongevity.com. There's a section there called How to Buy. And on that section, we list all the dealers where it's available. We also give on that website our contact info. So I've got a team who talk with investors. We can't sell the fund. We're not registered fund salespeople. We're able to answer questions about the product and sort of point people in the right direction. So we love hearing from investors by phone, by email, however, and even a few people have come to see us in our office. We're on Adelaide Street near Bay in downtown Toronto in the financial district, and sometimes people make an appointment and come down for a coffee to talk about it with us.
Great. Any other comments or questions from the group? You can just speak out if you want. Unmute yourself. Dale, do you have any questions that are popping for you?
There's one I was holding on the when one's in the accumulation, and you mentioned turning 65, they start turning can they delay that if they like and pick their own sort of turn into income date?
Yes and no. I mean, functionally, yes. The way that you do it, the rollover is going to happen automatically. And I should point out, it's not a taxable event because two things are true. One, it's the same underlying portfolio of assets. So the basket of stocks and bonds held is not changing. And two, it's an automatic rollover, not an election. And so there's not a taxable event, which is relevant if it's in a non-registered account. What many of our investors are doing is rather than taking their distributions as cash, they're taking their distributions as reinvestment of units of the fund, right? It's very common to do that with other financial products. You can do that with this too. So if the fund is paying a distribution of $6 per unit, you can take that, let's say you've got 1,000 units, so you get a $6,000 distribution. You take that as $6,000 worth of units of the fund. What it means is effectively you're snowballing your units. You're choosing not to take it out. A lot of our investors are doing that. I forget the percentage, but I want to say it's around half are reinvesting. You can only do that until you're 80. Because it's a form of purchase, you can't do it once you turn 80. So you can't roll this thing over until you're 100 and then buy a big yacht or have a huge income. But you can do it until the day you turn 80, and then you're required to take the distributions as cash. So again, sometimes it's easy to think about distributions as cash being synonymous with spending. You're not obligated to then go spend that. You don't have to go find a fancy dinner to go blow it on. Many people can reinvest this. It stays within the account. So if it's within a RIF and you're not at your RIF minimum withdrawal level, you can then invest it in other things. So it's the income is different than the decision to spend.
Just want to reference the question that we got from the email that we talked about earlier. Did you discuss the difference between Class A and F funds? I don't know if that's still relevant.
Yeah, no, for sure. I mean, so Class F is what most people use. I think it's 97% or so of investors in this fund are in Class F. That's kind of the standard advisor and or self-directed investor class. Class A is a trailer paying. So a lot of mutual funds where the advisor is advising a client on it and they're not charging the client an account level fee. They're not scraping a regular annual fee from their client account. The fund pays a 50 basis point trailer. So 0.5% per year, the fund pays directly to the advisor's dealer. So if you buy this through an advisor who says, I think you should put $10,000 in the longevity pension fund. I'm going to buy Class A units because that's what my account agreement with you says. they will be getting a payment from the fund, similar. Likely A class using advisors likely do that with all the funds they put in their client's account. It just gives A class advisors the ability to use this too.
I got it. Okay. Great.
Okay, well, thank you. That's been
Thank you, Fraser.
you've been very attentive and patient. You can see my passion and depth on this. It's been a pleasure speaking with you. But happy to take questions. Visit our website and reach out, contact@retirewithlongevity.com if you have further questions.